Hey investors, welcome back to Stoxpot. It's me, Lekshman M J. In this episode, we are breaking down the latest results of three interesting companies: TVS Supply Chain Solutions, Dharmaj Crop Guard, and Insecticides India. Before we begin, just a quick disclaimer. This podcast is purely about business insights and not investment advice of any kind. I only talk about what's happening in the market, what's driving a company's growth or decline, and what lies ahead. Like the show name Stoxpot, just view this podcast only as a place to spot various stocks. So grab the information presented here only as the initial point to start your own analysis. So having said this, without any further delay, let's get started. First up, we have TVS Supply Chain Solutions. In the third quarter of this financial year, the company reported a 10% year-on-year revenue growth driven by 20.4% growth in network solutions and a 2.3% growth in integrated supply chain solutions. For those who don't know about the difference between these two services, there's a simple way to understand it. Imagine a client of TVS needs to transport goods from point A to point B by ship and then from point B to point C by truck. At this moment, if TVS handles everything with its own logistic resources, that falls under integrated supply chain solutions. But now, assume a situation where ship is not fully loaded but the client needs faster delivery. Now, TVS will use its network solutions and will partner with the third-party logistic providers to complete the shipment on time. Of course, the real difference between these two services is not limited by the scope of this example. I just told you this example only to give you a basic idea about these services. Now coming back to the results, while revenue has increased, the profit after tax took a hit this quarter. But why? The company says a delay in commissioning a major European project and a seasonally weaker period with lower volumes dragged the profits down. Despite facing these challenges, the company remains confident about its long-term growth, backed by a strong order pipeline and by already having a steady margins in India and North America. In case of Europe, the company expects the margins to normalize by the first quarter of FY26. Now let's move on to our next company, Dharmaj Crop Guard, one of the fastest growing agrochemical companies. In Q3 of this financial year, the company delivered an impressive 41% year-on-year revenue growth driven by strong performance in its branded and institutional formulation business, followed by a further boost from active ingredient segment, which is now an emerging growth driver. Before proceeding ahead, let's quickly break down what these terms mean. Let's start with what is active ingredients. The chemicals that kill weeds, control pests, and protect crops are called active ingredients. Having said this, now let's see what is formulation. The process of mixing active ingredients with non-reactive additives to create a final product for agricultural use is called formulation. With that out of the way, let's get back to business. The formulation business saw volume-driven growth despite lower price realizations. However, the branded formulation segment faced challenges in Rajasthan and Uttar Pradesh, leading to a strategic re-evaluation in the region. But South Indian markets showed strong early traction for the same segment. Meanwhile, in the active ingredient segment, revenue growth was solid, but initial expenses weighed on the profitability this quarter. However, as operations scale up, margins are expected to improve. Looking ahead, the company remains bullish, expecting a strong growth in branded formulations, better export performances with Bangladesh reopening, and expanding sales in new markets. Now let's show our final spotlight on Insecticides India Limited, a company in crops and nutrition space. In Q3 of this financial year, the company registered a flat revenue growth. But here is the interesting part. Its EBITDA jumped 19% and profit after tax soared 42%. The question in my mind at this moment is how did this happen despite registering a no revenue growth for the quarter? The answer lies in its strategy. At the beginning of the year, the company shifted its focus to premium products to boost margins, and that move paid off. Even if we look at the first 9 months of the financial year, its revenue was down by 3%, but EBITDA was up 26% and the margins expanded by 268 basis points during the period. And as a clear evidence to the effectiveness of its strategy, during the first 9 months, the contribution from the premium products constitute 62% of the total B2C revenue. Looking ahead, the company is optimistic, expecting a strong demand in the upcoming season, supported by a good monsoon and higher reservoir levels, increased crop sowing activity, and favorable government policies to increase crop production and increase farmer income. The company believes these factors will give additional momentum to its business in the upcoming quarters. And that's it for today's episode. If you find this podcast useful, make sure to follow and share it with your friends and family. I'll be back soon with another deep dive into the latest corporate trends. Until then, bye.